Subscribers to the FastGraphs YouTube channel have asked to see the following 17 stocks in recent comments that they've made. We're going to be looking at Amazon, Algonquin Power and Utilities, Dominion Energy, Walt Disney, Exelon, Alphabet, aka Google, Global Payments, Hasbro, LyondellBasell, Meta Platforms, aka Facebook, NXP Semiconductor, Owens, On Semiconductor, Southern Company, Tyson Foods, VF, and Verizon Communications. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Subscribers to the channel are often asking me to analyze various stocks for them. And one of the advantages of the FastGraphs research tool, by the way, is that you can just immediately look at a stock and in just a matter of almost seconds know an awful lot about the company that would require just arduous amounts of research and effort to try to figure out on yourselves without the perspective the FastGraphs offers. So in the spirit of this, I'm going to look at 17 stocks in this video. I am familiar with some of them, and some of them I'm not familiar with at all. So I'm going to simply do a cursory review here, and I'm going to essentially share with you what I see just by looking at the FastGraphs. Now, since there are 17 stocks in this particular universe that I'll be doing today, I'm going to only look at a couple of metrics maybe on each company, but I want you to also recognize that FastGraphs provide you the ability to look at a company from almost every fundamental aspect you can. So let's go ahead and get started. Let's start with number one, Amazon. We all know who Amazon is. We probably all shop at Amazon. But what we also might not know, or some of us know anyway, is that Amazon has not always been a real profitable company. There were many, many years where they didn't make any profits at all. And you can clearly see that on the FastGraphs looking at adjusted operating earnings here. However, when you switch to operating cash flow, you get a really different perspective of Amazon. You see that Amazon has generated very strong operating cash flow growth. And when the cash flow growth did weaken in 2021, the stock price weakened with it. But now cash flows are expected to grow strongly again in the future. So there is a lot of promise for Amazon's future. Recent cash flow growth has been slower than normal, but it's also expected to accelerate, as you can see here. The other aspect of Amazon is to look at it from a sales point of view. And this is a price to sales graph. And you can see Amazon was trading at very lofty price to sales for the last several years, but has now become inexpensive relative to what the market has normally priced Amazon at relative to their sales. So that's our first one here, Amazon. Let's move on. Let's look at Algonquin Power and Utilities. This is a multi-utility company. And what I see here, I don't know really much about this stock. I've never researched it, never looked at it. But by just looking at the FastGraph, the first thing that strikes me is how high their payout ratios are, at least relative to earnings. This is earnings per share, and the white line on this graph is dividends per share. And what you see is, the area below the white line is what percentage of earnings they paid out. And there are cases, and I can show you this better by going into the forecasting graph, where the company is paying out a lot more than they earn to their shareholders. And I've seen recent reports talking about a dividend cut is likely, because when we look at this company from the standpoint of earnings, it doesn't look too bad. Now, I was asked to review this stock because it had this, huge drop here, right here, just in one day. But you'll notice that it's had really a huge drop, going all the way back to August of 2022. We had a massive drop. There was a 30% drop here just in a couple of days. Now, you can get some insight into that by going and looking at operating cash flow and see that operating cash flows have been faltering here recently, but are expected to recover. The company does pay a 9.42% dividend yield, assuming that dividend doesn't get cut. All right. So the point is the operating cash flow has covered the dividend except for the 2021 period, and is expected in 2022 that it's well covering the dividend as well based on analyst expectations. Of course, the year's almost over, and we'll see what's happening. Now, we can look at the performance history here, And we can look at 2022 and see that they did raise their dividend to 18 cents a share in the July quarter. Whether they maintain that or not I'll leave that up to you to decide for yourselves. But that's Algonquin Power. The next company I'm going to look at in the list is Dominion Energy, another multi-utility. One thing about utilities that I've stressed over and over again, they tend to be relatively slow growers. Now, for whatever reason, and again, I've not researched this stock, so you would have to look this for yourself. I can see that the company did slash their dividend from a high of $3.67 down to $2.52 that they paid in 2021 and expected to go up maybe 7% to $2.67, but that's still going to be significantly below what their normal dividend has been. Now, when I look at this company from a standpoint of cash flow, generally the company's cash flows have covered their dividend. And if I look at free cash flow, I don't see that. And that's not unusual with utility stocks like this because of the capital intensity that the companies need to do to continuously reinvesting in power plants, et cetera. But the point is, this stock has been really overvalued for many, many years here, in my opinion. They should be trading at or below the orange line like they were in 2008. They have now come into fair value. In spite of the dividend cut, they're yielding still 4.34%. It's a triple B plus company. And if you're looking for income going forward, this might be one that you might want to look at further. But, I don't like the low growth aspect of this particular utility, but I do like the fact that it's more reasonably valued now than it's been in years. Disney, we all know what happened with COVID. They closed the theme parks. Disney's cut their dividend. There's controversy going on with the change in CEO that has just occurred. You can see the stock has fallen precipitously from its all-time high when I was arguing that Disney was massively overvalued, and that was without forecasting a lot of the trials and tribulations that the company's gone through. Now, if you're looking to speculate in a company like Disney, which is triple B plus rated, they've slashed their dividend temporarily. If the new CEO puts the company back on track, this could be a great opportunity to be picking up Disney if you're a long-term investor. But, there still would be expectations for trouble ahead. The company is going through a lot of controversy right now. But I do want you to see the effects of massive overvaluation and how it can really affect even the best of companies, which Disney for many, many years was considered one of the best of the best. The next company to look at is Exelon Corporation. It's an electric utility. Apparently, I want you to notice not only is it a low growth stock, but also look at the cyclicality. There are times when, earnings fell. And then during this whole period of time here, we had very low earnings growth. Every now and then you get a good year. The stock came into the Great Recession really significantly overvalued. It looked like it had been growing. And again, I don't know this company very well. I don't like its valuation even now. I consider it overvalued. It does offer a nice 3.37% dividend yield. It is triple B plus rated, which is a good high quality rating, one below A, but it is an investment grade rating. I want to point that out. But I don't like the valuation of the stock right now. I think when you're looking at stocks like this, you really want to be buying them at a bargain. And right now, I would say the stock is too expensive relative to what it can ultimately produce you. I personally would look at this graph and pass on even doing any work on it. Exelon. But if you like utilities and like this stock, I'll let you, again, make your own decisions up. Google, or Alphabet, aka Google, is a very interesting company. You can see it's been a very strong grower. It does not pay a dividend. There's no white line and no light green shaded area on this graph. So I immediately see that it's a non-dividend payer. You can see that the stock price has followed earnings. And now when we had a down year in earnings in 2022, we saw a significant reset in the company's stock price. So, that's something to, take into consideration. But notice the high rate of growth the company has achieved going all the way back to 2004. But watch what happens when I shorten the time frame. That growth rate has been cut in half. And now all of a sudden, Google starts to look like it might have been a little bit expensive. I dropped that to 8 years and, it's holding up at that point. I dropped that to the last 4 years and it's still holding up. So, possibly, the company's been growing pretty well, but future growth does not look as strong as it was. But the analysts are expecting over 14% growth going forward. And when you're dealing with a growth stock like Alphabet, it always pays to check other sources. And I, like to go into, Yahoo and check for other sources of earnings estimates. In the next 5 years, these guys expect the report to Reuters, I believe it is, about 9% growth. They expect 11% growth for next year. Here, these guys in FactSet, of which are only 4 analysts, I might add, are forecasting 14%. So there's a pretty big divergence there. If I look at the normal growth, these FactSet analysts are expecting 12% growth versus the 11.5%, but that's, reasonable. But I would consider Alphabet maybe still slightly pricey relative to what the future might be. But again, you can invest accordingly. However, if there was a time to be buying the stock in recent years, this drop in the stock price has really created a much better valuation proposition than the company has normally had. Global Payments is a stock I like a lot if you're looking for growth. This company has, earnings have grown very, very consistently over the years, averaging double-digit rates. I want you to notice the stock price has tracked that until we hit this irrational, exuberant period that we've had in the last several years. Following the Great Recession, stocks began to get really frothy. The stock has corrected dramatically. By the way, it started paying a dividend in 2019, but has a very modest yield. So this is more of a growth story. Analysts expect this company to grow at 13% for the next, couple years on average going forward. And the 5-year average is also 13%. It's a triple B minus company, has modest debt. I really like the growth of this company. And it's a data processing and outsourced services. They do a lot of payment processing and so on for almost every industry you can think of. I like this company a lot, and I really like the current valuation. This is one I may be doing a deeper dive on in the future here. Hasbro is a very interesting, toy manufacturer, as we know, leisure products it's called. You can see it's had pretty steady growth. Now we came into the COVID era here, and the company's got a little bit cyclical. We saw the price drop dramatically. The company does offer a 4.5% dividend yield. It has become, very inexpensive relative to historical norms. In other words, if you were going to buy the stock, this might be a good time to buy it. Looking at the company going forward, it is expected to grow at over 7% for the next couple of years. But the long-term growth rate is a negative 7%. I really don't understand that. I don't know why it's, thought of that. So I went ahead and checked Yahoo estimates. And I went into Yahoo, and Yahoo does expect 8% over the next several years. So when you see stuff like this, what FastGraphs is doing is just sharing what is being reported to them. So this is something you would want to look into. If I went into the custom calculator and put in that, we'll call it 8.3% growth rate that, we saw on Yahoo, it does change the picture here dramatically. So Hasbro is one that would require some research and effort. It does pay almost over 4.5% dividend yield. I think it's obviously a well-known good company, but I think you would have to do your own homework. Since it is a dividend payer, I like to look at operating cash flows have, nicely covered the dividends, and also free cash flow has generally covered the dividend, although that's gotten a little weak here, which might be what's affecting the stock price. But that's Hasbro, probably a better buy today than it's been in the last couple of years. LyondellBasell is a commodity chemicals company headquartered in the Netherlands, does offer a 5.48% dividend yield. It's expected to have, a down year in 2022 after a really spectacular year in 2021. I'm not sure what all that was about. The company's dividend record, they did cut their dividend after they first started paying one, but for the last 7 or 8 years, they've had a pretty good dividend record, so you might want to look at this company's long-term dividend capabilities. From an operating cash flow point of view, the dividend looks well covered. From a free cash flow point of view, the dividend looks well covered now, and it did get a little bit, dicey coming out of COVID, but the company, did maintain their dividend growth during that period of time. So you might want to take a closer look here. Meta platforms, Facebook. I think I want to look at this one from a standpoint of adjusted operating earnings. The company had really tremendous operating growth for many, many years after they initially went public in 2012-ish. So if you look at their growth, it was very strong. But this is a growth stock, and it's the nature of the beast. And if you're going to make money in growth stocks, you have to be willing to pay a premium for high growth when it occurs. But when the music stops, when the growth begins to slow down, as it's obviously done here in the last couple of years, and it's not expected to do much going forward, according to these analysts. Now, whether they're right or not, only time will tell, but they're not expecting much growth for the next several years. If I double check this with Yahoo also has negative growth rates forecasts for Facebook or Meta platforms in the next couple of years. So I think the real story here is don't be enamored by their record, their historical record. If you're going to invest in them, you want to be really thinking about what the future really holds for the company. Now, what I will say is the valuation now is certainly better than it's been in many, many years. You have to go back to see a price of, $111 a share. You can go all the way back to 2016 before you saw that kind of price. But of course, the valuation back then was high, and it looks a lot more reasonable now. But this is one that is, going to be tricky to invest in going forward. My main message is don't buy this based on its past. Look to what the future might hold for Facebook and then make your decisions accordingly. The next one would be NXP Semiconductor. This is a semiconductor manufacturer. It's had good, consistent growth. It did suffer a little bit during the COVID crisis, but it actually held up pretty well, all things considered. It did start paying a dividend in 2018 pre-COVID. They maintained that dividend and grew that dividend since they've been paying one. It currently offers almost a 2% dividend yield. It has an earnings yield of over 8%. I like this company going forward. Looking at it, I've not done a lot of work on this company, but this is one that I do plan on researching a lot closer for looking for a total return type investment. I do like this company at these levels. The valuation, as you can see, is clearly opportunistic relative to historical precedents. Owens Corning, which is building products, you can see this company's price has tracked its earnings. It's a semi-cyclical company, started paying a dividend in 2014. It's had explosive earnings growth for the last couple of years. I'm not sure, we all probably know what that's a result. Housing was crazy. It is expected to have a down year, which kind of maybe is what's holding the stock currently back. It is a triple B rated company. It does offer a 1.5% dividend yield, offers a 13.5% earnings yield. The question is, what are earnings going to continue to look like going forward? And, long-term growth is expected to be still pretty strong, even double-digit by the analysts following the company. So this could be one that if you're looking to, for a total return investment with a little bit of a dividend kicker, you might want to take a closer look at Owens Corning. Again, I might do that myself. On semiconductor, you can see how, it's been a relatively flat grower here for all these years, had a couple of nice years in 2016, 17, and 18. Then they, of course, came into COVID, and they had, a couple of down years, and then earnings have exploded since then, and the stock price has reacted to that. However, we are forecasting a negative year next year, and that could have, some impact on the stock. So it's the kind of thing that you would want to research more deeply and look into if you were going to invest. I think this, even though it looks like it might be attractively valued here, I don't think this is normal growth, and it's not something I think you should be thinking about going forward. Again, do your homework. Southern Company is a really nice utility, triple B plus rated. It's been a consistent grower. The market has always put even a premium multiple of about 16 on the company. However, it trades at a higher multiple than that now. I like this utility if you can buy it at the right price. It does offer an attractive 4% dividend yield. But the point I want to make is the valuation right now is high. It really makes sense to buy this at least when it's, quote unquote, trading at a 15 or below PE. But I don't like buying it here because I don't think it provides the opportunity that you deserve as an investor. But I like the company. I just don't like the valuation. Tyson Foods, is one that's very interesting. If you shorten the time frames here, notice how your perspective changes. It's currently trading at a low valuation, but we are expecting a down year next year. Now, what something like this would mean, at least to me, is you could be expecting some bad news coming out on the stock over the next couple of quarters. And that could have all kinds of effects on the stock price. It could keep it low. It could drive it lower. It could be reacting. Of course, any good news could also be a catalyst to give a rise. Stock pays 2.85% dividend yield, has an earnings yield of 12.5%, is triple B plus rated with low debt. So I kind of like Tyson Foods. I think it's one that you might want to take a closer look at if you're looking for income in or growth. VF Corporation is an interesting one. The market for many years was valuing the stock very high. COVID came, of course, in being in the apparel, accessories, and luxury goods industry. the stock did take a big hit. I also want you to notice that they shifted from a calendar fiscal year of December in 2016 to a March fiscal year in 2017 and 18. So there's like 2 extra quarters, I think it is, in this particular picture here. So it's a little bit, screws up the charting a little bit, but the stock does look inexpensive right now. The forecasting graph puts it at reasonable value, but they don't expect a lot of growth. But this 1.97, don't let that mislead you. That's because we're expecting a down year this year, which obviously has already priced the stock lower, but we're expecting double-digit growth over the next couple of years and long-term growth. Analysts, the reporting aren't giving me any growth there. So, don't get caught up in the number. Always look at the detail when you're looking at these stocks. And then last but not least is Verizon. Verizon is a very slow growth. Integrated telecommunication services is its sub-industry. But, it provides, obviously phone services to people. The stock has got very, very inexpensive. Notice that the growth is really very, very low, less than 2%. Analysts are forecasting almost an average of negative growth, but again, really slow growth looking at it going forward, something under 1%. The only salient feature about this stock is I look at it like almost a bond alternative now. It's got a almost 7% dividend yield, and it's trading at a very low valuation. One thing that people forget is that even a no-growth company or a no-growth investment is worth a multiple of their earnings. If you think of a bond, and a 5% bond is paying 20 times interest, is being priced at 20 times interest, $1,000 bond. And so what you've got here is an expectation of about 11 multiple being fair value on this stock. But you also have periods in history, if you look at the long-term growth rate, of a 14 or 15 multiple, very often. So this would be a recovery play with a very high dividend yield. I think it's relatively safe from a standpoint of losing money at this point. But on the other hand, I don't think it's really not a growth stock. It's really an income vehicle at this point. And I think that's how you look at it. Anyway, this has been Chuck Carnevale saying thank you for watching. Hope you enjoyed this. This is a subscriber request series. I want you to understand that you need to go in and do your own research on these stocks. I'm just showing you what FastGraph is telling me just by looking at the graphs. And I hope you got that message from this video. You can instantly look at a fast graph and see what kind of company you're dealing with, what its history has been, and what its future expectations might be. As I like to say, fast graphs provides essential fundamentals at a glance, and it can really save you a lot of time and even a lot of money in determining whether you should even spend the time to research a stock, and certainly whether you should spend the time to buy it, or for that matter, if you own it, sell it. Hope you enjoyed the video. If you did, give me a like, ring the bell, subscribe to our channel, and take a look at fast graphs. You can see how powerful this is in analyzing individual stocks. And we looked at a really eclectic group here that subscribers have asked me to look at, and so that's what I've done. And I want to be clear, I've not researched any of these stocks fully. I leave that up to you. Thanks for watching.